Welcome back to the show, everyone. If you're listening to this, chances are you're either already a property investor or you're itching to get your foot on a ladder. We talk a lot on this show about capital growth, about location, about interest rates. But today we're going to talk about the silent thief in your portfolio. Actually, let me rephrase that. It's not a thief taking money out of your pocket. It's a thief preventing money from coming back into it. I had a client come into my office recently. Let's call him Dave. Dave is a smart guy. He bought an investment property back in late 2017. He's held it for 5 years. He came to me to look at his cash flow, and after digging through his numbers, I had to deliver some bad news. I told him, Dave, over the last 5 years, you have voluntarily donated about $10,000 to the Australian Taxation Office. He was shocked. He asked how. The answer was simple: depreciation, or rather, the lack of it. Dave had fallen victim to a massive misconception in the Australian property market. He thought that because he bought a second-hand house, he wasn't entitled to claim depreciation. He thought those tax breaks were reserved for shiny new builds. Because of that one false belief, he missed out on claiming about $7,000 a year in paper losses. At his tax bracket, that was a $2,000 to $3,000 cash refund he missed out on every single year. Today, we're going to fix that. We're going to perform a deep dive into the world of property depreciation. We're going to cover exactly what it is, the massive law changes in 2017 that confused everyone, the difference between plant and equipment and capital works, and why you need a quantity surveyor, not just an accountant. If you want to legally claw back thousands of dollars from the tax man, grab a notebook. You're going to want to write this down. Segment 1. The magic of the paper loss. Let's start with the basics. What exactly is depreciation? In the simplest terms, it is compensation for wear and tear. If you buy a car for business, you know that the moment you drive it off the lot, it loses value. The tax office recognizes this. They allow you to deduct that loss of value from your income. Now apply that to a house. A building is just a giant physical asset. Every year, the bricks get a little older, the carpet gets a little more worn, the hot water system gets closer to its death date. Here is the magic of it, though. Unlike other expenses, like paying your property manager, paying council rates, or paying mortgage interest, depreciation is what we call a non-cash deduction. Think about it. To claim a deduction on your interest, you physically have to pay the bank cash. To claim repairs, you have to pay a TRA-DI. But with depreciation, you don't have to spend a single extra dollar this year. The money was spent when you, or the previous owner, built the house. You're simply claiming the aging of that asset against your taxable income. It improves your cash flow without costing you cash. It is the only line item on your tax return that behaves this way. So, why do so many people miss it? Segment 2. The 2017 game changer and the second-hand myth. Let's go back to my client, Dave. Why did he think he couldn't claim anything? It goes back to a major legislative change in Australia that happened on May 9th, 2017. Before this date, the rules were the Wild West. You could buy a 10-year-old house, and you could claim depreciation on the used carpet, the used dishwasher, and the used air conditioner. The government realized that people were essentially claiming deductions on items they didn't actually pay for, items that had already been depreciated by the previous owner. So, the government drew a line in the sand. They said, if you exchange contracts on a second-hand property after May 9th, 2017, you can no longer claim depreciation on previously used plant and equipment. This is where the confusion started. Real estate agents and even some uninformed accountants started telling people, oh, you bought an old house? No depreciation for you. This is 100% false. And it's a costly lie. To understand why, we have to get technical for a second. In the tax world, depreciation is split into 2 distinct buckets. You need to memorize these: Division 40 and Division 43. Division 40 is your plant and equipment. These are the things that are easily removable. The mechanical and removable assets. Think blinds, carpets, ovens, dishwashers, light shades, ceiling fans. The 2017 rule says, if you buy a second-hand house, you generally cannot claim Division 40 on the old stuff that was already there. The value of those items is deemed to be $0 for you. However, there is Division 43. This is capital works. This is the skeleton of the house. The bricks, the mortar, the concrete slab, the roof, the walls, the tiling. The good news: the 2017 rule did not touch Division 43. If you buy a house that was built in 1990, 2000, or 2010, the structure itself is still depreciating. And here is the kicker. Capital works usually make up about 80% to 85% of the total depreciation claim anyway. So, when Dave decided not to get a depreciation schedule because he lost the right to claim the used carpet, he threw away the right to claim the walls, the roof, and the floor. He threw away the stake because he couldn't have a garnish. Segment 3, the mechanics. Now that we know we can claim, how do we calculate it? There are generally two methods you can choose from. Again, this is general information, so always chat with your accountant, but you need to understand the concepts. Method 1 is the prime cost method, which is often called linear. This spreads the deduction evenly. If you buy a $5,000 air conditioner and it has a 10-year life, you claim $500 every single year until it hits zero. It's consistent. It's flat. Method 2 is the diminishing value method. This is the aggressive approach. It assumes that assets lose more value in the early years. Think about that car again. It loses the most value in the first 3 years. Under this method, your deductions are front-loaded. You might claim $1,000 in year 1, $800 in year 2, $600 in year 3, and so on. Which one should you choose? Most investors I work with opt for diminishing value. Why? Because of the time value of money. $1 in my pocket today is worth more than $1 in my pocket in 10 years. Inflation eats away at purchasing power. If I can get a $4,000 tax refund this year to put into an offset account or use for a deposit on the next property, that is infinitely better than waiting 10 years to get that same money. We want to accelerate our cash flow now to reinvest it. However, there is a catch with old properties. The capital works, which means the building structure, is locked at a flat rate, usually 2.5% per year over 40 years. You can't accelerate bricks, but you can accelerate the appliances if you buy them new. Segment 4, the renovation opportunity and scrapping. This brings me to a massive opportunity for those of you who love a fixer-upper. Let's say you buy that 1980s brick home. It's tired, it's ugly, but the structure is solid. You decide to do a renovation. You rip out the carpets, you paint the walls, you put in a new kitchen. Two things happen here regarding tax. First, the new assets. Everything you buy brand new, the new stove, the new blinds, the new floating floorboards is yours. You're the first owner. That means the 2017 restriction does not apply. You can claim full Division 40 depreciation on all those new items. You immediately create a massive tax deduction shield. Second, the concept of scrapping. This is a pro tip that isn't in the basic brochures. Let's say that old 1980s kitchen you ripped out still had a residual value on paper. Maybe the ATO says those old cabinets were technically still worth $2,000. When you throw them in the skip bin, you are effectively destroying an asset. You can often claim that remaining value as an immediate 100% deduction in the year you destroy it. This is called scrapping. But, and this is a big but, you can't just guess the value. You need evidence. This is why you must engage a professional before you start swinging the sledgehammer. Segment 5. The quantity surveyor, your new best friend. This leads to the most practical question. How do you actually claim this? Do you just keep your receipts and give them to your accountant? No, that is a recipe for disaster and high accounting fees. Your accountant is a genius at tax law, but they are not construction cost estimators. They don't know the current cost of a linear meter of Gyproc or the installation cost of a duct heating unit. If you hand your accountant a shoebox of receipts, they have to manually enter every single item. It'll take them hours, and they will bill you hundreds of dollars an hour. You need a quantity surveyor. A QS is a construction economist. They are one of the few professionals recognized by the ATO to estimate construction costs. You hire them once. They usually charge between $400 and $700. They inspect your property or do a desktop assessment if possible, measure everything, count the PowerPoints, measure the square footage of the carpet, and estimate the construction year of the building. They then produce a tax depreciation schedule. This is a 20 or 30-page document that maps out the deductions for the next 40 years of the property's life. You take this report, email it to your accountant, and say, here you go. Your accountant enters two numbers from the report into your tax return, and boom, you're done. It saves you accounting fees, and it maximizes your return. And the best part? The fee you pay the quantity surveyor is 100% tax deductible. So the real cost to you is minimal. When should you do this? The source file I was reviewing mentioned a great point. Ideally, get the inspector in before the tenant moves in or immediately after a renovation. It's just easier logistically. They don't have to arrange access with a tenant. They can see the condition of the floors clearly without rugs covering them. But if you already have a tenant, don't worry. A good QS arranges access directly with the property manager. You don't even have to be there. Segment 6, Beyond Residential, the commercial angle. I want to take a quick detour to mention commercial property. Often, we get tunnel vision on residential houses. But if you own a commercial warehouse, a shop front, or an office suite, depreciation is just as powerful, sometimes more so. Commercial properties often have higher wear and tear and different effective lives for assets. Whether you occupy it yourself for your business or lease it out, do not neglect the depreciation schedule. The construction costs of concrete, tilt panel warehouses, or office fit-outs can generate substantial deductions. The principle is the same. If you didn't do a report because you thought it's just a warehouse, you're leaving money on the table. Segment 7, the negative gearing trap. Now, we need to address the elephant in the room. I need to issue a serious warning. I've spent the last 15 minutes telling you how great depreciation is. It sounds like free money. And it is tempting to go out and buy a brand new house and land package just because the depreciation schedule promises you $15,000 a year in tax deductions. Do not do this. This is the negative gearing trap. I see investors buy properties in terrible locations with oversupply issues just because the tax benefits looked juicy. Remember this. You should never spend $1 just to get 45 cents back from the taxman. Depreciation is the icing on the cake. It is not the cake. The cake is capital growth and rental yield. If you buy a property that drops in value by $50,000, no amount of tax depreciation will save you. The strategy should always be find a high-quality asset in a high-growth location. Ensure the cash flow makes sense. Then use depreciation to maximize your post-tax return. Don't let the tax tail wag the investment dog. The goal of investing is to make money, not to lose money to get a tax refund. Segment 8, Addressing the Old House Nuance. Before we wrap up, I want to address one final hesitation I hear from owners of very old homes. You might own a Victorian terrace built in 1900 or a post-war brick home from 1950. You think, surely, the 40-year window for the building structure has expired? You might be right regarding the original skeleton. If a house was built in 1950, the original bricks have depreciated to zero value in the eyes of the ATO. However, rarely does a house sit untouched for 70 years. Previous owners have likely done extensions. They've renovated the bathroom in 1995. They added a pergola in 2005. They rewired the place in 2015. Unless you have the receipts from the previous owner, a quantity surveyor can come in and estimate the date and cost of those renovations. If they estimate that the lounge room extension was done in 2005, you can still claim depreciation on that specific part of the building. My advice? Contact a QS firm. Most of them will do a preliminary check for free. They will look at the property online and tell you, look, honestly, there's no value here. Don't bother paying us. Or yes, we see about $3,000 a year in deductions. Let's proceed. You have nothing to lose by asking. Conclusion. So, let's bring this all together. If you own an investment property in Australia and you do not have a depreciation schedule, you are essentially walking past a pile of money on the street and refusing to pick it up. It's not too late. If you miss claiming it for the last 2 years, your accountant can often amend your previous tax returns, usually up to 2 years back, to claw that money back. The 2017 rules. Yes, they restricted plant and equipment on used houses, but they left the capital works, which means the building structure, wide open. This is where the bulk of the value lies. The process: don't DIY it. Don't dump receipts on your accountant. Hire a quantity surveyor for a one-off tax-deductible fee. The mindset: use depreciation to boost your cash flow, pay down debt, or save for the next deposit. But never buy a bad asset just for the tax perks. In a high-interest rate environment like we are seeing now, cash flow is king. An extra $200 or $300 a month in your pocket from a tax variation could be the difference between holding a property comfortably and being under financial stress. Do yourself a favor. Go check your files. If you don't see a document titled Tax Depreciation Schedule, make a phone call today. That's it for this episode. As always, none of this is personalized financial advice. I don't know your specific tax situation. Go talk to your qualified accountant and a quantity surveyor. If you found value in this, please share this episode with a friend who owns a rental property. You might just save them a few $1,000s. Thanks for listening, and I'll see you next time.